I would like to highlight how volatility affects, both short-term and long-term investment strategies. How market volatility affects short-term, versus long-term investment strategies. So in the case of short-term investing, you have number one, opportunity for quick gains. For the short-term investor, you know, uh, fluctuation in stock price will always present, an opportunity for short-term gains. So high volatility creates significant price swings, offering short-term investors opportunities to profit from rapid market movements. For short-term traders or swing traders, they tend to profit during moments of volatility, particularly when it favors them. Strategies like day trading and swing trading often rely on volatility to generate returns. They focus essentially on volatility. They may disregard, company fundamentals. They may disregard company financials. They depend solely on, market movement generated by volatility. Number two is increased risk. Increase risk. Sharp price changes can lead to substantial losses if trade move against prediction. If you predict that the market will rise, if there's a sharp decline in prices, it will lead to larger, losses. And so short-term investors must manage risk carefully using tools like, stop loss orders. You utilize, stop loss to limit your losses on the downside. Number three is requires active monitoring. It requires active monitoring. So volatile market demands constant attention to price changes and news that may affect market movements. So you have to be very, very keen, and observe, carefully how news events could affect the markets. Number four is tools to navigate volatility. We want to consider tools that you could use to mitigate the impact of volatility, on your portfolio. Indicators like VIX, that volatility index, or the fear gauge. Tools like average true range. Tools like the Bollinger Bands help short-term traders anticipate market swings. So short-term traders, normally utilize these tools to navigate the markets and then reduce market risk. Number five is psychological impacts. I want to look at the psychological impacts of volatility. So high volatility can be stressful, actually stressful. It makes your stomach to churn, kind of. And it requires, emotional discipline to avoid impulsive decisions. If you're not really disciplined as an investor, you may end up selling, stocks of well-established companies with very strong fundamentals because of fear, because of panic. So you need to resist that particular temptation. You need discipline because volatility, will impact you, will infect, will influence you psychologically. And so in the long term, let's equally look at the impact of volatility. Number one here is less impactful over time. In the long term, it has kind of less impacts on your portfolio. Volatility tends to smooth out in the long term, with markets generally trending upwards over extended periods. In the short time it goes like this. In the long time it goes like this. It tends to fluctuate upwards, so it is less impactful over the long term. So long-term investors focus on fundamentals rather than on short-term market fluctuations. As a long-term investor, you don't allow short-term market noise, short-term market fluctuation to bother you. You focus essentially on your investment performance over the long term. Please like this video and subscribe to this channel. Right. And so number 2 is an opportunity for strategic buying. It offers opportunity for you to buy strategically. In this case, periods of high volatility often present opportunity to buy undervalued assets at lower prices. You may equally, incorporate dollar cost averaging to help you to mitigate the effect of market turbulence. So dollar cost averaging essentially involve, setting a specific amount of money. You buy stocks regularly. You may buy, monthly. You may buy quarterly. You may buy semi-annually. You do that regularly. A fixed amount of money. You buy, shares regularly. Number 3, risk mitigation through diversification. Diversifying across asset classes and industries reduces the impact of volatility, on the long term, because these assets generally don't correlate. They don't move in tandem. And so when you diversify across different assets, you discover that volatility in the stock market will not affect the bond aspect of your portfolio, and may not really affect the commodity aspect of your portfolio, and may not equally affect your cash. And so you are fully diversified. Number 4 is then focus on long-term goals. You focus on long-term goals. So long-term investors aim for steady growth, making temporary price swings less concerning, because you are aiming at maybe 5, 6, 7, 10 years. You don't really get bothered by what is happening, currently. As long as the underlying fundamentals of the stock you're invested in is okay, you don't get bothered by short-term market sentiments, short-term market movements, or noise in the market. Number 5 is that patience is key. You remain patient, discipline. Riding out periods of high volatility requires patience and a strong commitment to your investment objectives. These are my objectives. These are what I want to achieve. These are my aims and goals in investing. You just stick to them and forget about, what the market is doing, currently. You exercise patience. And so what are the key takeaway here? Short-term investing thrives on volatilities, but involve higher risk and requires active management. That is what traders are known to undertake. While long-term investing benefits from ignoring short-term fluctuations and focusing on consistent growth over time. And so understanding the role of volatility on each approach helps investors align their strategies with their goals and risk tolerance. So as a long-term investor, volatility should not be a problem to you. You simply remain patient and focus on your long-term objectives.